Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. When the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good afternoon, guys. Federal Reserve meeting coming up here. Markets pretty quiet, and I'm actually so I'm trying to build up a sim position here. I'm a little nervous because it's 5 minutes before they're not pulling. Usually they've pulled. I mean, a little bit is pulled. About half of it is pulled off of the 10-year. There is still a lot out there. So I think that somebody's got some big bets on, probably. And it kind of looks like somebody's buying this, which is kind of like, okay, that's what you're going to do. So, but markets haven't really moved much, so not really anything to go into. S&P 500 recovered a little bit from where it was, but the treasuries have basically just kind of gone sideways here. Oil majors paid off. Yeah, they are. They're about 50 cents higher here in oil. I didn't even realize that. Gold not doing so hot here. You think gold is anticipating a rise in rates here? Okay, now they're pulling. I'm going to take a bite here or two before the release comes, okay? I mean, I feel like it shouldn't need to be said, but there's always somebody stupid, guys. This from here until the close of the S&P 500 is likely to be extremely volatile and confusing. You are probably better off sitting it out unless you have a big account. I mean, you want to take the risk, just as long as you understand the risk that you're taking. Just know this is going to be insane. All right? Just eating Pop-Tart. All right, here we go, guys. 18.5 ends up being the price for the treasury. Hell yes. Hell yes. Hell yes. Come to Papa. Cool. Okay, so the monthly taper base will be 30 billion versus 15 billion prior, which is double the pace that it was before, as expected. That's the big point on that one, right? Now I'm waiting for dot plot stuff. My machine can't even keep up. J Badge is warming up. Well, seeing that initial move is gonna rile them. Well, okay, hold on. What we got here in ES? Can we try taking one in ES? Right, maybe there. This is like sell all the things. Gold getting destroyed, 6J getting destroyed, dollar. Oh man, dollar is just skyrocketing, 96.7 right now in the dollar. Dollar only thing going up right now. The dollar and yields are the only things on my screen moving up. Okay, so here's the statement comparison. So they have removed the summer's rise in COVID-19 cases have slowed their recovery. Inflation is elevated, largely reflecting factors that are expected to transition. And they change it to continue to be affected by COVID-19. Job gains have been solid in recent months, and the unemployment rate has declined substantially. So they got rid of the transitory bit in there. They decided to keep the target range for funds at 0 to 0.25%, with inflation having exceeded 2% for some time. They did not change the statement very much. They did not change the statement very much. Interestingly enough, the 10-year is not yet to 1.5. I'm awfully tempted over here. I think that there's probably more in this. Okay, now, other important thing for us to note here, the yield curve flattened once again. Now we should be careful with that. There might be some profit taking on the flatteners here. The guys with the flattener, they are making money. Let me tell you what. They are making money. Let's remove that, by the way, because it's just not accurate anymore. Oh, and let's dump this E-mini trade because I caught the worst spot. I'm still looking for, okay, what are the projections and stuff? I'm still waiting for the picture of the dot plot. I'm not seeing that chart that I would expect to see. Is Bitcoin? Oh, I don't even have Bitcoin. Bitcoin is moving up. Well, that's a little silly. I am quite surprised it's up here a little bit. Well, how much of that was before Fed? 48. That might not last. Let's let that one play out. now is that the ES is going to be pushing highs of the day. Okay, so hold up. What's going on here? Now expects 3 rate hikes in 2022. Okay, here it is right here. So yes, they're right. So now they seem to expect that there will be by the end of 2022. See, that would be 3 hikes would be 0.75, right? And some of them are saying that by the end of 2023 that there might even be more than that, right? So this is quite hawkish. I think that is more hawkish than anticipated. That the dot plot is, because they're basically saying now that there's a really high chance that they'll raise rates in like March. Once the taper is done, there's a really high chance that they'll raise rates, because again, these are like that. So that's like 1 hike, 2, 3, 4, 5, 6. Like there's some people saying that by the end of 2023 there'd be 7. Like that they'll be at 1.25. That's pretty crazy. Seems like we're pumping though. Well, I have to wonder here. So in the ES, so first of all, let's just remember that they're going to flop around, and some of these are going to do really paradoxically bizarre things, right? So let's not read too much into these. Like the very initial move, pay attention to that. But what we're getting right now is just the backwash, right? So let's just kind of see what they do. The S&P 500 seems to be reasonably happy with it so far. The market is pricing in an end to the tightening cycle in 2024, basically saying that they're going to raise rates up to there and then they'll probably stop. The expectations are hawkish and as follows. Turbocharge the taper, bringing monthly bond buys to $75 billion, a $25 billion cut instead of a planned $15 billion. This is very consensus. Oh, no, wait, that was before. Because I'm very sure that I read that it was 30,000, right? That zero hedge story, I think, is not completely up to date. I think that this part down here was what they were expecting. Yeah, the dots definitely changed, though. I'm not going to tell you what to do. I don't think I would want to be in Bitcoin right now, but again, the markets could do some really paradoxically, some really bizarre, confusing, unintuitive things here, right? The dollar rising there, definitely, leads to pretty much everything else getting hit. Bitcoin rising there is really bizarre. Yeah, 47 to 50K isn't really a huge deal. So it's not, I wouldn't call it like a huge trade, but that one right there, you kind of have to wonder if it's not somebody trying to push it to try and convince everybody that, oh, everybody's afraid of the Federal Reserve and we want to buy. They're trying to turn it into something that's not, I'm not sure. Okay, futures suggest traders estimate a 74% chance of a Fed raise in April, and then a 100% chance in May. Well, it doesn't matter here now. So if we come back to the FOMC price, though, I might start adding in. Like right now, just remember we're still in the hole. We're still in low liquidity, slippery, falling down everywhere kind of area. So it's kind of hard to judge where it's actually going to go. Showing inflation hedge? No, I don't think so. Well, I am seeing gold. Now that is interesting. Gold is coming back. Oil is moving up. So are all of the hard assets reversing their moves and moving higher now? This could be very good for my portfolio, the way that this is all playing out today. Maybe I need to pull up my long-term portfolio, because I've got some oil in there, I've got some gold and silver in there, and I've got long rate stuff in there. I don't know. I'm not 100% sure how to read. There's, a lot of stuff. Okay, here's what Fed's hiking cycle market backtest shows. No, that's not what I'm looking for. That will be an interesting one to read later, though. Like within the range of expectations and the things that we were looking for, the Fed is aggressively dialing back its monthly bond buying, and we are going to see, or they are anticipating, 3 rate hikes next year. So when I look at this, I have a really hard time seeing how the 10-year doesn't get to 1.5 today. But, and I mean, it did move down initially. It did move down a lot, so I shouldn't be complaining, but it seems like that they could go more. All-time high today? It could be. So one theory I should put out there in ES is that all of this is bad for the risk on trade in the S&P 500. But people were so hedged and everything that now that the risk event is past, they can buy. That might be part of what's going on. Yeah, they taper by 30 billion, which is double what it was before in November, about 15 billion. Some of the reactions in ES here, I wouldn't really interested to see what is the reason for that flow. Well, we think rates are going to rise here. I'm going to put one in there on the rates too. So if they reverse, I expect everyone puking at it, and it could, right? We could see, now we're seeing like strong buying in the S&P 500 that could just flip straight on its head and all of a sudden be at its lows very easily. Yes. The treasuries are starting to lurch lower again. Well, I tell you what, if the S&P 500 is going to buy, then the treasuries are definitely going to sell, right? Well, yeah, Bitcoin kind of fell back a little bit. I can't see the DOM, so it's super hard to see what is going on there, but there's a pretty good chance that that's where they would be at for sure. Although in this kind of case, so we're in like low liquidity everything anyways, right? So we should just expect price to be really slippery. The marketeer asks, "Can the Santa rally start now?" Actually, it probably could. Maybe it could. I mean, that's the way it's going right now. I'll see. 4650 is a kind of there was some pushback on that one, I would say. Just a little bit of pushback from 4650. Okay. So now they're pricing 90% in March. Curious. Although the 10-year hasn't moved that much. 10-year really hasn't moved that much. Look at the look at the liquidity in the 30-year micro futures. Good grief. It's like it's not just the 4-tick spread that you normally got, but then there's only like a few guys there in the middle, and then there's two prices with nothing on it beyond that, and then there's the big market maker out there. Like, holy cow, man. Breaking: Federal Reserve officials with one of the most hawkish policy pivots in years as they intensify their battle against the hottest inflation in a generation, says Jennifer Jacobs of, isn't she Jim Cramer's, whatever the name of his website is. That's where she's from. Well, an oil spiking above 71 there for a moment. The dollar, no, not the dollar, gold saw some initial selling, really heavy selling, and it bounced back hard. It's turning back down a little bit, so we still kind of gotta wait and see how that one sorts itself out. The treasuries did start to decline a little bit there, but maybe now some support in the 12.5 area. I'm not 100% sure. I'm also seeing a little bit of some steepening coming in. So, like I said, those flatteners really made money. I think we would have to expect some profit taking on that trade. So this is interesting because I think that the takeaways from the release, at least the initial release so far, are pretty clear, but how it's affecting assets is a little confusing in some places, huh? Treasuries seem to be doing what we would expect, but not anything else. S&P 500 is up. So what's going on there? Yeah. So Mohammed El Arain pointing out the same thing. The immediate reaction of the markets includes stronger stocks, a flatter yield curve, and a stronger dollar. It will be interesting to see how all three evolve as the Federal Reserve Chair Powell shares more of the Fed's thinking at the upcoming press conference. I really think he could say some things that will roil the markets. I really think. And they're probably likely to be hawkish things too. That's all my thoughts so far. That, and I'm sure I'm glad that I went and took this sim trade short so that I can brag about it, even though I'm not actually making any money from it. We got 10 minutes to the press conference, so keep that in mind, and just remember that the markets are going to continue to be a little wild here through the press conference. So I guess I should come over here and pull that up. YouTube.com/Federal Reserve. And then I need to make sure to mute it. There we go. So I'll probably put the Fed over here. You won't be able to see me. It'll just be like this. That, if that's okay. Yeah, we'll definitely be streaming the press conference. I gotta keep it muted for now though, so that I don't get copyright takedowns. Well, I definitely see that steepening coming in. The 30-year kind of dragging down, and the 5-year pushing them up, and some big orders holding things. Like there's a really big order at 120, 23 a quarter in the 5-year. Liquidity in the 10-year is still pretty weak. And equities failing here. Coming back at least. Too much firepower exploded to the upside. Normal pull. Yeah. Normal pullback. Can't really say that it's like a clear liquidity hole per se, but just because liquidity is low everywhere, right? It just means it doesn't take very much to move this market right now. AMD 3.4% up? Really? Well, Treasury's still kind of steepening a little bit. They took a small step down there. Five minutes to the press conference. We'll see where we go. Gold still struggling to try and make a move. Well, I really want to see if they trade that 23 and a quarter in the 5-year. So I'm seeing that the volume seems to be selling, but the bits in the 10-year seem to be holding okay. Okay, so they swept them there, but took 1,000 contracts. The 10 and the 5 moved there. Oh, and look there, they traded them in the 5-year. The guy that wanted to buy 25, well, it wasn't 3,000, but 25.56 traded at 23 and a quarter there. And the S&P 500 coming back to the scene of the crime here. That was at like 46.20 and a quarter. Right here, FOMC. And there's the treasuries swinging back to kind of, I guess, the midpoint at 13. Yeah, wow. Okay, so like I didn't even realize, but like the 30-year like barely budged at all. The 30-year barely reacted to this at all. Hey, CD-ROM, how we're doing? We're doing okay. We're just chilling here and waiting to see what Powell says in the press conference. Yeah, 90% in April and a 50% in March. Yeah, it's pretty crazy how the Fed funds has changed there. Now this is kind of weird. So like Brannigan says, the Fed delivers mostly in line with expectations, marginally hawkish on 3 hikes in 2022. I'm just sitting here and I'm like, okay, like is it in line with expectations? It was on the hawkish side of the expectations in every way. And if anybody was expecting it to be dovish, they were crazy, right? But the range of expectations here for this, I think, were pretty narrow anyways, right? Then he says, as long as Powell doesn't hint at a hike earlier than May 2022, then we're off to record highs over the next few sessions. Maybe. I think that a lot of people in the S&P 500 took trades up there on that kind of thesis and are kind of unhappy at the moment. He's doing his shakeout still. Yeah, it's just the volume is just going to shove it around a lot. Right? Okay, so here's Powell. So I'm going to turn financial juice off here.
As I will explain,
unmute Powell.
Economic developments and changes in the outlook warrant this evolution of monetary policy, which will continue to provide appropriate support for the economy. Economic activity is on track
Well,
to
that
expand
his
at a
his
robust
his
pace
talk
this year,
just sounds
reflecting
hawkish to me
progress in
already.
vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continue to foresee rapid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 5.5% this year and 4% next year. Amid improving labor market conditions and very strong demand for workers, the economy has been making rapid progress toward
So
maximum
the
employment.
30-year shoving
Gains
down
have been
there a
solid
little
in
bit more
recent months,
aggressively
averaging
is
378,000 per month
could
over the
accelerate
last
things for
3
the
months.
treasuries there. Yeah.
The unemployment rate has declined substantially, falling 0.6 of a percentage point since our last meeting and reaching 4.2% in November. The recent improvements in labor market conditions have narrowed the differences in employment across groups, especially for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor force participation showed a welcome rise in November, but remains subdued, in part reflecting the aging of the population and retirements. In addition, some who otherwise would be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. At the same time, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. How long the labor shortages will persist is unclear, particularly if additional waves of the
When
virus
Powell is
occur.
talking, you can get a
Looking
lot
ahead,
of really
FOMC participants project the labor market to
difficult
continue
to
improve,
follow moves, right?
with the median projection for the unemployment rate declining to 3.5% by the end of the year. Compared with the projections made in September,
Note,
participants
though,
have
that the
revised
30-year is
their
getting
unemployment
sold
rate
pretty hard
projections
here.
noticeably lower for this year and next. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. As a result, overall inflation is running well above our 2% longer run goal, and will likely continue to do so well into next year.
Ouch.
While the
Treasuries
drivers
just
of
got
higher inflation have been
diced right there.
predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader
in
range
large
of
order
goods
there,
and
pushing the
services.
5-year down.
Wages have also risen briskly, but thus far, wage growth has not been a major contributor to the elevated levels of inflation. We are attentive to the risks that persistent real wage growth in excess of productivity could put to upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline to levels closer to our 2% longer run goal by the end of next year. The median inflation projection of FOMC participants falls from
Okay, so that
5.3%
that
this year
push
to
down in the
2.6%
treasuries
next year.
seems to have strained
This
the
trajectory
liquidity,
is
and
notably
they're having a
higher
hard
than
time
projected in
extending.
September. We understand that high inflation
Dixie don't
poses
care.
significant
The
hardship,
dollar
especially on
index
those
really
least able to meet
skyrocketed
higher
up there. Look
costs
at
of
that.
essentials like food, housing, and transportation.
Here, let's make it bigger so you can
We are
see.
committed to our price stability goal. We will use our tools both to
And
support
the dollar
economy
index
and a
looks so
labor
strong.
market, and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the
Now there's a
economy
big
is
order
evolving
shoving
in
down
line
the
with
30-year.
The Fed's monetary policy actions have been guided by our mandate to promote maximum
Somebody saw
employment
that
and stable prices
the
for the
30-year
American
had barely budged after the move, and it was
In
like,
support of
oh
these
no,
goals,
you
the
don't.
committee reaffirmed the 0 to
Dragged it down.
1.25% target range for the federal funds rate. We also updated our assessment of the progress the economy has made toward the criteria specified.
I come back
in
here
our
and look at the
guidance for
30-year
federal
chart,
funds rate.
right?
With inflation having exceeded 2% for some
No
time,
no
the committee
movement
expects it will be
after
appropriate
the
to maintain
news.
this target range Until labor market
very
conditions have reached levels
subdued,
consistent
and
with
now
today's
finally they
assessments of
shoved it
maximum
below overnight lows.
All FOMC participants forecast that this remaining test will be
So
met
this
next year.
is
The
steepening.
median projection for the appropriate level of the federal funds rate
It's
is
gradual, but
0.9%
it's steepening.
at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its longer run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases. Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November.
Okay, so
We're
the
phasing out our
30-year
purchases more rapidly because
getting
with
some
elevated
relief
inflation
there.
pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support. In addition, a quicker conclusion of our asset
Still pretty
purchases
slippery,
will
though.
better position policy to address the full range of plausible economic outcomes. We remain prepared to adjust the pace of purchases if warranted by
Wow,
changes
a
in the economic
9
outlook.
tick went 900
And
plus.
even after our balance sheet stops expanding, our holdings of securities will continue to foster accommodative financial conditions. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank
Had a
you. I
little
look forward
hitch
to
in
your
data
questions.
there.
Thank you, Mr. Chair. We'll go to Rachel from the Washington Post.
Thank you very much, Michelle, and thank you, Chair Powell, for taking our questions. The latest FOMC materials say that the FOMC thinks it will be appropriate to keep rates near zero until labor market conditions reach levels consistent with maximum employment, and there are also 3 rate hikes penciled in the projections for next year. In order to set up those hikes, what will maximum employment have to look like? When will you know that that threshold has been met, and how will that be communicated? Thank you.
So maximum employment, if you look at our statement of longer run goals and monetary policy strategy, maximum employment is something that we look at a broad range of indicators. And those would include, of course, things like the unemployment rate, the labor force participation rate, job openings, wages, flows in and out of the labor force and various parts of the labor force. We'd also tend to look broadly and inclusively at different demographic groups. And
A
not
little
just
bit
at
of
the
a fight
headline
right there,
aggregate
10.
numbers. So that's a judgment for the committee to make. The committee will make a judgment that we've achieved labor market conditions consistent with maximum employment. When it makes that, it is admittedly a judgment call because it's a range of factors. Unlike inflation, where we have one number that sort of dominates, it's a broad range of things. So as I mentioned in my opening remarks, in my view, we are making rapid progress toward maximum employment. And you see that in, of course, in some of the factors that I mentioned.
What is that? Okay, so he was not saying anything that seems significant, but the Treasury's really moved there.
Thank you, Mr. Chairman. My question is, if it's often said that monetary policy has long and variable lags, how does continuing to buy assets now, even though it's at a slower pace, address the current inflation problem? Won't the impact of today's changes not really have any impact for 6 months or a year down the road?
Maybe it's because I'm delayed a little bit.
Actually
I don't know.
lengthening that time by continuing to buy assets such that it could be not until the long and variable lag after you end purchases sometime in March that you'll start to have any impact on the inflation problem?
So on the first part of your question, which is why not stop purchasing now, I would just say this. We've learned that in dealing with balance sheet issues, we've learned that it's best to take a careful, sort of methodical approach to make adjustments. Markets can be sensitive to it, And we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go. So we announced it, and that's what will happen. The question of
He's
long
right,
lags
of course.
is an interesting one. That's Milton Friedman's famous statement, and I do think that in this world where where the global financial markets are connected together, financial conditions can change very quickly. And my own sense is that
what's it doing this
financial
for?
conditions affect the economy fairly
That's
rapidly.
weird.
Longer than the traditional thought of a year or 18 months, shorter than that rather. But in addition, when we communicate about what we're going to do, the markets move immediately to that. So financial conditions are changing to reflect, the forecast that we made, and basically, which was I think fairly in line with what markets were expecting. But financial conditions don't wait to change until things actually happen. They change on the expectation of things happening. So I don't think it's a question of having to wait.
Can I just follow up in thinking about having to wait? Is it still the policy or the position of the committee that you will not?
It's like somebody is trying to make something happen here. I don't know there's some movement there in the treasuries.
Yes,
The 30-year is
the sense of that, of course,
getting
being
pulled
that,
back down again, though.
Buying assets is adding accommodation, and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected,
Wow.
I think if we wanted to lift off before then you would stop the taper potentially sooner. But that's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Okay, let's go to Colby at the FT.
Thank you,
The
Michelle.
way that the
Chair Powell,
micros are
I'm
moving here,
curious
I'm wondering
exactly
if there's
how
like
much
some
distance you think
big
there
bond
should
trades
be
going on in the
between
cash
end of the
market.
taper and the first interest rate increase. Back in 2014, the guidance was that was given was for the Fed funds rate to remain at the target level.
Could also
for
be
considerable
because the
time
dollar.
after the end of the asset purchase program. Is that an approach you support now, or does the current economic situation warrant something a bit different? Thank you.
So we haven't made any decision of that nature, and so no, I wouldn't say that's our position at all. We really haven't taken a position on that. I will say that we did talk today. We had our first discussion about the balance sheet, for example, and we went through the way the
I feel good, Seth, man. I was panicking for a moment. Panicking about what?
The runoff and that sort of thing with the balance sheet last time. And I think people thought that was an interesting discussion. They thought that it was
Bitcoin seems to be
but
holding
people
its
pointed out that
gains,
this is
especially Ethereum.
significantly different economic situation that we have at the current time, and that the differences that we see now would tend to influence how we think about the balance sheet. And the same thing would be true about raising rates. I don't foresee that there would be that kind of very extended wait at this time. The economy is so much stronger. I was here at the Fed when we lifted off the last time, and the economy is so much stronger now. It's so much closer to full employment. Inflation is running well above target, and growth is well above potential. There wouldn't be the need for that kind of long delay. Having said that, we'll make this decision in coming meetings, and it's not a decision that the committee has really focused on yet.
I can't tell if this is fighting or if it's just volatility, man. It kind of looks like fighting in the 10-year to me.
Thank you. Nick Tamaros at the Wall Street Journal. Chair Powell,
Yeah, crypto lives to fight another day. It's quite surprising that they're up there.
You said 4%.
It could still fall. Crypto has a tendency to do this, right? Where when you get to a news event that could be really bad for them, they buy anyways, and then after an hour or two, it goes back down.
That's achievable in the short run versus in the long run.
I don't think we can rest easy over there in crypto world.
Changed this year, and if so, how?
He's just saying negative things positively. It really is. I mean, it's a hawkish Federal Reserve decision at any way you slice it.
The thing is, we're not.
It was a hawkish end of the market expectations.
Early on, the sense was that's where we were headed. The post-pandemic labor market and the economy in general will be different, And the maximum level of employment that's consistent with price stability evolves over time within a business cycle and over a longer period, in part reflecting evolution of the factors that affect labor supply, including those related to the pandemic. So I would say, look, we're at 4.2% now, and the unemployment rate has been dropping very quickly. So we're already in the vicinity of 4%. The way in which the important metric that has been disappointing really has been
that 30 is still getting pulled down.
Of course, where we had widely thought, I had certainly thought that
Garlic coin go into $1 regardless. I hope so.
Employment insurance ran off as vaccinations increased.
They got awfully close there
reopened,
before, didn't they?
That we would see
Earlier in the year.
Surge, if you will, or at least a surge in labor force participation. So we've begun to see some
1,000 at 12.5
the 0.2 improvement that
uptick.
we got in the November report. But I do think that it feels likely now that the return to higher participation is going to take longer. And in fact, that's been the pattern in past cycles, that labor force participation has tended to recover in the wake of a strong recovery in unemployment, which is what we're getting right now. So it could well have been that this cycle was different because of the short nature of it and the very strong, the number of job openings, for example. You would have thought that would have pulled people back in, but really...
Oh, doesn't expect rate liftoff before March, no extended wait.
We don't have a strong labor force participation.
That might have been why we got some of the movement that we had.
For some time. At the same time, we have to make policy now. And
I didn't catch when he said that. So I didn't register in my mind.
To take into account.
If I could follow up.
Liquidity health is not really a pertinent thing in this kind of environment, Eric, just because liquidity is low overall.
Compelled to raise interest rates before you're convinced that you've achieved the employment test in your forward guidance.
So this is not at all a decision that the committee has made, but you're really asking a question about how our framework works. And yes, there's a provision, what used to be called the balanced approach provision, that says in effect that in situations in which the pursuit of the maximum employment goal and the price
they're
goal
really
are not
they're really steepening it here.
We have to take account of the distance from the goal and the speed at which we're approaching it. And so that is in effect an off-ramp which could, in concept, be taken, and it's in our framework. It's been in our framework a long time. I've talked about it on a number of occasions. It is a provision that would enable us to, in this case, because of high inflation, move before achieving maximum employment. Now, as I said, we're making rapid progress toward maximum employment in my thinking, in my opinion, and I don't at all know that we'll have to invoke that paragraph. But just as a factual matter, that is part of our framework and has been really for a very long time.
Thank you.
Thanks. We'll go to Howard at Reuters.
Thanks, as usual. So I guess I got to ask about the elephant in the room, which is the Omicron variant. This seems to already be pushing one of your colleagues, the Bank of England, off its course. Things have evolved very fast there. Hasn't quite hit the shores of the U.S. in full force yet, but people seem to expect it to. So I'm wondering, in your feelings about this, are you convinced that this is going to be perhaps a more infectious but less serious variant of the virus, or are you simply confident that the U.S. economy can continue its divorce from the pandemic?
Well, I think there's a lot of uncertainty, which is why we called it out in our statement, our post-meeting statement, as a risk. We follow the same experts, and we talk privately to the same experts that everyone else does.
Oh, I forgot that I moved over here. You can't see him. That's okay. You don't need to see him.
So you mentioned the early assessment is highly transmissible, perhaps not as severe, some continuing protection from existing vaccines and also existing immunity from having had the disease. That's a first draft. We're a long way from knowing what it will turn out to be. It may well come to the United States and replace Delta as the dominant variant fairly quickly. That could easily happen. I think there's another step there, though, which is what's going to be the effect on the economy, and that will depend on how much it suppresses demand as opposed to suppressing supply. It is not clear how big the effects would be on either inflation or growth or hiring. On top of what's already going on, which is quite a strong, wave of Delta that's hitting large parts of the country across the northern United States and all the way to the eastern seaboard, and now coming down. We're having quite a wave of Delta. So coming in on top of that, again, it's very difficult to say what the economic effects would be. I do think wave upon wave, people are learning to live with this. More and more people are getting vaccinated. So people who get the new variant, it affects them much less than it tends to affect in the aggregate people who are not vaccinated. So the more people get vaccinated, the less the economic effect. It doesn't, it won't have an economic effect. Delta had an effect of slowing down hiring, and it actually it had an effect on global supply chains, and that sort of that hurt the process of the global supply chains getting worked out. So it can have an economic effect. I just think at this point we don't know much. We'll know a whole lot more in 3 weeks, and we'll know more than that in 6 weeks.
So what he just said there was really important about how is the Federal Reserve going to react to Omicron. And he kind of put the kibosh on all we need to hold off because of Omicron.
We're comfortable the economy can handle it without quantitative easing.
Yes. I think if you look at the state of the economy and the strength of demand, the strength of just overall demand, the strength of demand for labor, look at inflation, look at wages. I think moving forward the end of our taper by a few months is really an appropriate thing to do, and I think really Omicron doesn't really have much to do with that.
Thank you.
Well, it's pretty choppy.
The New York Times.
A little bit maybe of a move back again in the Treasury.
Could talk a little bit about what prompted your recent pivot toward greater wariness around inflation.
Sure. So I guess I would go back and, it's been a continual process, really. Inflation really popped up right in the late spring last year, and we had a view. It was very widely held in the forecasting community that this would be temporary. It was quite narrow.
And then they move up again.
A number of factors were causing it, and there was a decent amount of evidence to support that view that it would be temporary or transitory, as we said. Certainly, we had 5 months
some
of
big prints up there at 46.50 in the ES.
Of inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, we started to see it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we moved the taper forward. And it's a much faster taper than had been planned. So we've been adapting. I've been saying we're adapting our policy. So come to your real question. We got the ECI reading on the eve of the November meeting.
As that's happening, the treasuries are recovering back up. Gold
reading for
is
the employment compensation
looking pretty good
quarter,
here.
Not annualized, for the third quarter, just before the meeting. And I thought for a second there whether we should increase our taper. Decided to go ahead with what we had socialized. Then right after that, we got the next Friday after the meeting, 2 days after the meeting, we got a very strong employment report, and revisions to prior readings, and no increase in labor supply.
They back to the FOMC price? Are you kidding me?
High reading, and I honestly at that point really decided that I thought we needed to look at speeding up the taper, and we went to work on that. So that's really what happened. It was essentially higher inflation and faster, turns out much faster progress in the labor market. Really what's happening is the unemployment rate is seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle. So that's really what happened. And, widely supported in the committee today. As you can see, unanimous vote, but beyond that, I think widely supported this move.
If I could just follow up quickly, you noted that the ECI was one of the things that made you nervous, but you also said earlier that
There's some
wages are actually factoring
shoving
into
around
inflation
going
here.
there
And
at
I guess I
4650 in
wonder how you
ES,
think
isn't
about
there?
sort of the wage picture as you're making these assessments.
Right. So what I said, you quoted me correctly. It's so far we don't see wages are not a big part of the high inflation story that we're seeing. As you look forward, let's assume that the goods economy does sort itself out and supply chains get working again, and maybe there's a rebalancing back to services and all that kinds of thing. But what that leaves behind is the other things that can lead to persistent inflation. In particular, we don't see this yet, but if you had something where wages were real wages were persistently above productivity growth, that puts upward pressure on firms, and they raise prices. It would take something that was persistent and material for that to happen, and we don't see that yet. But with the kind of hot labor market readings, wages we're seeing, it's something that we're watching. And the other thing, of course, is rents, which are very important. Owner's equivalent rent and rent. That's another thing which is very economically sensitive. Unlike the things that are causing the inflation now, this is economically sensitive, and so would be expected to move up. And so as some things go down, the question is, where will we be when we come out the other side of this? And we need to keep our eyes on those things.
Thank you.
Thanks. We'll go to Chris at the AP.
Thank you. Well, next year you could see growth slowing, and you could see some disinflation, particularly if the Omicron variant does spread more widely. Would you delay rate hikes in that situation? And
Did you see that big order there for a second?
And
Where'd it
also,
go?
how would you explain
There's a
rate
big
hikes
order,
if they
and it
do
looks like it
follow
disappeared.
through? In that kind of situation, with inflation fading and growth slowing, how would you explain rate hikes to the public, particularly those who may still be looking for work?
Well, as you know, the SEP is not a plan. It's not something we debate, negotiate over, or really discuss in terms of what the right answer should be. People write down their
strong stack at 16.
assumptions, their
There
assessment
you are.
of appropriate policy based on their
4K.
economic forecast. And so the median, what you're talking about, the 3 rate increases, that's the median of the committee. The median of the committee is also that growth will be 4%, and that unemployment will be 3.5% by the end of the year. So that's a really strong economy. And of course, if the economy turns out to be quite different from that, then so will the rate. No one will say, oh, we can't change our policy because we wrote something down in December. That no one's ever said that or will. The actual rate decisions we make will depend on our evolving assessment of the forecast. So, for example, if the economy were to slow down significantly, then you would expect that would have an effect of slowing down rate increases. But we'd have to, we look at our 2 goals, maximum employment and price stability, and we make policy based on them.
Bearish on what? On
And not with respect to
Bitcoin?
what we wrote down in a prior SEP.
Thank you. Let's go to Victoria.
I would say it was pretty bearish on Bitcoin, but hey, the day's not over yet.
Hi, Chair Powell. I wanted to follow up on maximum employment. So, the new framework was basically designed, as I understand it, so that there was a de-emphasis on guessing where inflation would pick up because of employment. And basically, you were going to wait until you saw the whites of the eyes of inflation, and that's how.
Now we're getting the
So
close
I'm
right here.
wondering,
This is the pick
you
close.
talked a lot about the different ways that you might measure maximum employment, but from what I understand, and that's still basically the way that you know that you're there,
was actually a pretty light pick close for the treasuries.
And how are those signals likely to be clear right now, given that you have
bearish on equities? I disagree with that very much.
Might also lead to inflation and wages.
I'm like expecting. I did take a little short in there. Like I'm expecting that higher rates will drag on equities, but I still believe that in the later half of December that we will see a lot of money come into the market.
It really was a completely different thing. It was to do with strong monetary policy.
I'm not sure that it makes sense for the ES to be like taking off the way that it is.
there were these supply-side barriers.
I think that we'll probably, if you were to buy the S&P 500 today and hold it until the end of the year, that you'd probably be happy.
Automobile purchases are very interest rate
I
sensitive.
mean, that's what I'm doing. I'm long right now in equities.
You can't because they don't have semiconductors. So that it was a very different kind of inflation. This is not the inflation we were looking for under our framework at all. It's nothing to do with our framework and the way.
I'm interested to see if the action in the treasuries here change now that the PIK closes happened. I am seeing that the flow has changed a little bit. We're back to mostly market selling.
Quantities, and the main price you look at is wages. It's one of the things you look at, and it's. So I mentioned a number of the things. You could get to 20 if you wanted to easily, but labor force participation, the unemployment
still
rate,
steepening yield curve.
Groups of prime age labor
30-year getting dragged down there pretty hard.
The JOLTS data get a lot of
He's
focus.
going all in.
And wages, that's really one of the great signals. The quits rate is another one.
I'm not saying that like that's Seth's prediction. That's Goldman Sachs' prediction. I trust them.
Labor economists.
That's all I'm saying.
People quit because they feel like they can get a better job, and there's record amounts, historically high levels of that going on, suggesting again that you've got a very tight labor market. So on wages, that's the price indicator we look at. To tell us, along with all the other data,
when that 13th to get filled,
we have labor market conditions that are consistent with maximum employment, and so that's how we think about it. But the one of the complications is that again we've got to make policy in real time. So how do we think about that? If we think we can make labor, participation might move up. If let's say we knew that it would start to move up in 2 years, would we wait 2 years or when inflation is running way above target? Probably not. So you have to make an assessment that what is the level of maximum employment that is consistent with price stability in real time is one way to think about it.
Just to kind of follow up on that for a second, if you do raise interest rates next year and you're not certain whether you're at maximum employment, I mean, are you all going to point, when you raise interest rates, are you going to point to ways in which the labor market could still improve?
Yes, I mean, I absolutely. I think whether or not we say we're at conditions.
He's kind of stuttering over his words because she's trying to get him to make like some sort of a commitment, and he doesn't want to.
We would all be open, and I think expect over time that the level of maximum employment that's consistent with price stability would increase further over time. For example, through increasing participation.
Yes, taking a look at that 50 level again.
We would not in any way want to foreclose the idea that the labor market can get even better. But again, with inflation as high as it is, we have to make policy in real time. We've got to make that assessment in real time.
Nothing too unusual.
We'll go to Olivia from Bloomberg.
Thank you. Good afternoon, Chair Powell, and thank you for taking our questions. I wanted to follow up on some of your earlier comments about labor force
a little bit right there at 50 that they can't. They have to get through.
Change in the economy
to
get a meaningful recovery in labor force participation, and also whether running the economy hot, like in the last expansion, is one way of doing that.
Okay, fine.
Well, the labor market is, by so many measures, hotter than it ever ran in the last expansion. If you think about it, the ratio of job openings, for example, to vacancies is at all-time highs. Quits, the wages, all those things are even hotter. But what would it take for labor force participation to move up?
Yeah, you see the icebergs too.
That really why.
Was it interesting? It took 1,700 to get through it, but once they did, they really ran, didn't they?
Some validity. Part of it will be that people, for certain people, they don't want to go back in the labor force because either they're medically
yield curve seems to be calming down
back, while COVID is still everywhere. That's one thing. The lack of availability of childcare for caretakers is certainly part of it, not just for children but for older people. It has been pointed out by many.
Do you know where you can scalp Bitcoin or Ethereum from DOM software? I haven't seen one that's super good, to be honest with you.
The same thing with people's houses. People buy they have a mortgage, and
I think there's a lot of features, extra features that to really scalp it on the DOM that you would need.
And they might reach the same
but
conclusion.
The bigger thing is I wouldn't really recommend scalping Bitcoin.
that because they couldn't spend on travel and things like that, and also because of because of government transfers. So for all of those reasons, and it's hard to know exactly the part each of them plays, we have a situation where we've had a shock to labor force participation that is not unwinding as quickly as many has expected. And people, in effect, a good part of it is voluntary.
Look, I thought that I did good with that one. I think I deserve the fill at 13.
That's certainly their choice.
Come on.
In other cases, it's something that will abate.
It's just a sim order. It's not.
Even when the pandemic gets under control, and the longer the pandemic goes on, maybe the less likely that people will come back because they're, they get used to their new life and they lose contact with their old jobs. That's what the evidence would say. So it's a range of things.
What was the 900 tick there again?
It isn't that the economy lacks stimulus. Usually in every other expansion, it's that there aren't enough jobs.
Well, let's just remember this movement that we're seeing in the S&P 500. It's not necessarily because of the Federal Reserve decision. It could just be like a relief rally sort of a thing.
To work it out, I think it's going to be time. And number one thing it would
everybody was kind of risk off before the FOMC. Now the big bad event happened. Now everything can calm down, right? And equities can go into buy again.
That would be
I don't know.
The thing that we'd really like to see, but it doesn't look like that's coming anytime soon.
And just to quickly follow up on that, if some of the reason that labor force participation isn't back to, February 2020 levels because people are voluntarily making life decisions that are different, does that make you think we're going to end up at a lower rate overall?
Well, there's a demographic trend underlying all of this. And we actually got above the demographic trend at the end of the last expansion. So one would expect over time that labor force participation would move down because in an aging population, the older people are, the lower their participation rate is. So you would expect that the trend would be lower and that over time participation would move
oil
down.
pushing highs, E-minis pushing highs.
We can get back up closer to
gold pushing
where we were in
highs,
February of 2020, and
Bitcoin
indeed
pushing
for the year or
highs.
so before that is a good one. And I mean,
interest rates rose, but not a ton.
The conditions. There's a lot of good for society when you have a tight,
sounds like
but
what do you mean?
labor market where people are coming in, they're getting into labor.
He's just trying to troll me now.
Well, in the labor market.
Well, I'm just saying, you come in and you buy today, you think, the Federal Reserve is dovish. That means that it's like game on. Now I can buy for, until March or something like that. You might come to the wrong conclusion. But we do expect to see some bullish market action in December, and now that the big bad, volatility event is over, it could just be that we're seeing a rise because of that. So we just got to remember that when we see flows, there could be a couple of different reasons why those flows are coming through, and we need to investigate all of those different reasons and compare the actual market behavior against our different theories to see what fits best.
Longest in our recorded history, including the last one, which was the longest in our recorded history. That's what it would really take.
Right now, we still don't know much.
Back to the kind of labor market we'd like to see, and to have that happen, we need to make sure that we maintain price stability.
Okay, let's go to Edward Lawrence at Fox.
Be even return 2022. Well, I hope we all are. I hope we all are.
Michelle, and thanks for taking the question, Chair Powell. So I was looking at the census.
Listen, I shoot here. Let's go. Let's pull up my portfolio, huh?
And what you're seeing is fewer people spending at restaurants and drinking places, more people spending at grocery stores. You see electronic sales down.
Come on, I'm still. Thank you, sir.
Sales down.
I appreciate it. Was good doing business with you.
What's your level of concern the consumer may be turning away from this economy or pulling back because of inflation, the virus, or something else? Thank you.
We see consumer expenses very strong in this quarter. I don't know, Edward, whether you're talking about more shopping online versus shopping in the store, but consumer demand is very strong. Incomes are very strong, because people are going back to work and they're getting wage increases. Admittedly, some of the wage increases is being eaten away by inflation, but nonetheless, incomes overall are going up really significantly because of increased employment, and spending has been strong. There may be something in the seasonality that this year's holiday spending may have been pulled forward, and of course there may be effects from Delta, and there might be going forward from Omicron. But
so that move in the treasuries was pretty equal across the curve.
Personal consumption expenditures to be
the flattening that happened on the initial move has unwound. We're actually a little bit steeper.
Bloomberg.
I'm expecting that we should be steeper on the day. Oh, I have made some money today, but not very much, actually.
Or this meeting's economic
I thought that
projections
Goldman would be up
has been
a lot
revised
higher
up
on higher interest
significantly
rates,
for
but it's down
but barely moved for
0.32%.
2022 and 2023. You've said you expect inflation to fall significantly. Is that because you're going to raise interest rates, or because the virus is going to fade and the effects are going to fade? In other words, is it a question of when, not if, you raise interest rates?
So there's that 30-year.
That maybe your critics are correct.
My DOM is
might
kind
be
of
a
screwed
factor
up.
behind the
15 was the low of the session.
I'm looking at the SEP here, and the median forecasts for core and headline inflation did move up by 0.4 each. So that's a significant.
Let's reset things again so we can kind of benchmark that.
It's based on both of those things, I suppose.
Maybe right there.
I do think there's a broad expectation among forecasters, including our own, that the bottlenecks will alleviate sometime over the course of this year. If you look at where blue chip forecasts are, which is the group of well-resourced large forecasting operations with a long track record, they'll show inflation coming back down significantly toward the back end of next year. I would say, though, as well, that
red or green. I think we'll be green by the end of the week.
But it should begin to have an effect.
There is some issues with Friday. So remember options expiration, right? But once we get into next week, I think that next week should be a green week.
We can't act as though that's a certainty, and we're not going to act as though that's a certainty.
Yeah, nice, sure. It's just a sim.
Now, we believe. I believe.
I caught a pretty good spot there between, what was it, 17 and 13, though? Pretty proud of that one.
Pressure, and that the risk of higher inflation becoming entrenched has increased. It's certainly increased. I don't think it's high at this moment, but I think it's increased. And I think that's part of the reason
making another push.
Our move today is to put ourselves in a position to be able to deal with that risk. And I think we are in a position to deal with that risk. We need to see more data. We need to see how the inflation data and all the data evolve in coming months. But we are prepared to use our tools to make sure that higher inflation doesn't get entrenched. For one reason, as I just mentioned, it's one of the two big threats, the other being the pandemic.
I saw a tweet that was inappropriate that was funny. I'm not going to read it, though.
Let's go to Michael Derby, The Wall Street Journal.
Okay, now ZB.
So as the Fed shifts towards an
sitting at the
what
lows.
your read is on financial stability risks right now. I mean, these periods can be, it seems like the taper process has gone fairly smooth so far, but what do you see in terms of stability risks? Are there any parts of the financial sector that concern you right now? And are there any significant systemic issues?
The 10 kind of coming back to that area where they did a lot of trade here. So we'll see if the 10 succumbs below 11 here now as well.
For a decade and more, a 4-part financial stability framework that we use so we can hold ourselves to the same kind of framework and not just treat each.
Did you see Pelosi say that politicians? No, did she really?
Valuations, debt owed by households and businesses, funding risk.
I have something to say about that if she did.
So I would say asset valuations, I'm going to go really superficially here, but asset valuations are somewhat elevated, I would say. Debt owed by businesses, and households. Households are in very strong financial shape. Businesses actually have a lot of debt, but their default rates are very, very low. But nonetheless,
we are a free market economy. They should be able to participate in that. No.
Among financial institutions.
Such a man. There's no way she remains speaker after this. After this next election,
this week.
Good riddance.
Leverage among financial institutions is
should just retire and be a day trader, Pelosi.
So overall, financial stability.
No, I got it. Business Insider has a story about it.
Would make an overall characteristic, but we break it down.
Let's see. Does they have a bigger
in terms of the things, that we're
quote?
We're looking at. you know, it's the things we've already talked about to some extent. It's the emergence of a new variant that could, that could lead to significant economic.
Well, Ocasio-Cortez definitely doesn't agree with the speaker, does she?
We don't see that. We don't have any basis for thinking that the new variant that we have is that one, but it's certainly one we're looking at. I would say, cyber risk, the risk of a successful cyber attack is, for me, always the most, one that we would be very difficult to deal with. I think we know.
Man, that the 30-year,
I think more
the 30-year really succumbed there, didn't it?
Financial institution or financial market utility would be a really significant financial stability risk that we haven't actually faced yet. So I could go on with a list of horribles, but I think that's
the story that I got here about Pelosi is not really all that interesting, but just the one clip that they have from her makes me mad.
That's going on in there in terms of, it's obviously a lot of time into that.
I don't think that Congress should be allowed to trade. I guess I need to become a congressman now. That's how we're going to become profitable, huh?
Financial stability concerns.
To become a senator.
Would support the views expressed in them.
Or maybe just become a senator's assistant.
Stablecoins can certainly be a useful, efficient, consumer-serving part of the financial system if they're properly regulated. And right now they aren't. And they have the potential to scale, particularly if they were to be associated with one of the very large tech networks that exist. And you could have a payment network that was immediately systemically important, close to immediately systemically important, that didn't have appropriate regulation and protections. The public relies on the government and the Fed in particular to make sure that the payment system is safe and reliable, as well as the dollar, and to provide a safe and reliable, trusted currency. So, but I do think those are longer term. In terms of the more the cryptocurrencies, that are really speculative assets, I don't see them as a financial stability concern at the moment. I do think they are risky. They're not backed by anything, and I think there's big consumer issues for consumers who may or may not understand what they're getting, and there's certainly developments in the markets that are worth following, which are really not in our jurisdiction, but things like the kind of leverage that's built into them and those sorts of things is certainly worth watching.
Let's go to Nancy Marshall-Genzer at Marketplace.
What about FedCoin?
Hi, Chair Powell. Thanks for the question. Going back to inflation, is the Fed behind the curve on getting inflation?
Hey, listen, I'm excited about FedCoin. I want to be involved in that. Right stuff for FedCoin.
I would say this. I actually think we are well positioned to deal with what's coming, with the range of plausible outcomes that can come. I do, and I think if you look at how we got here, I do think we've been adapting to the incoming data really all the way along, and noticing and calling out that both the effects and the persistence of inflation, of bottlenecks, and labor shortages and things like that. So we've been calling out the fact that were becoming longer and more persistent and larger. And now we're in a position where we're ending our taper within the next, by March, in 2 meetings, and we'll be in a position to raise interest rates as and when we think it's appropriate, and we will, to the extent that's appropriate. At the same time, we're going to be seeing a few more months of data. I don't actually think.
Forex Live has a picture of Jerome Powell on the front of Time magazine, flipping the camera off and saying, "Screw your puts."
Was a really strong signal that inflation is more persistent and higher, and that the risk of it remaining higher for longer has grown. And I think we're reacting to that now, and we'll continue.
Go E-mini.
So I wouldn't look at it that we're behind the curve. I would look at it that we're actually in position now to take the steps that we'll need to take, in a thoughtful manner to address all of these.
That's a take profit right there for me.
Too high inflation.
Let's go to Evan and market news.
I think they
Hi,
could
Chair
probably
Powell.
push it a little bit further
I
today,
was
but
wondering if we should still be seeing the taper and interest rate hikes as separate. And secondly, in the last cycle, the Fed started shrinking the balance sheet when short-term interest rates were about 1 to 1.25% range. Do you think the FOMC might be able to potentially start running off assets before that this time?
Are they separate? So our interest rate, yeah, they are separate tools. So the asset purchases are a separate tool from interest rates. Stopping asset purchases does not remove accommodation. It just stops adding further accommodation, whereas raising interest rates starts to remove accommodation from what is a highly accommodative stance.
that's not true.
The extent to which they'll be separated in time is something we haven't really discussed at the committee.
Sorry,
We will
Mr.
be
Powell, but
discussing
that's
that,
not
obviously, in
true.
coming meetings.
Removing asset purchases removes accommodation.
Quite a long separation.
So less orders buying
Interest rates, I don't think that's
increases
at all likely.
interest
This cycle,
rates,
we're in a very, very
hence
different
less
place with high inflation,
You're
strong
wrong,
growth,
but that's
really
okay.
strong economy.
I'm sure Zero Hedge will let him have it
mentioned,
in all their articles tonight.
3.5% unemployment at the end of the year, and the headline inflation of 2.6% next year, core at 2.7. So this is a strong economy, one in which it's appropriate for interest rate hikes. So they're separate, I would say. Your second question was?
My second question was about runoff.
Runoff.
In the last cycle.
So with the balance sheet, we did have a balance sheet discussion. It's our sort of first discussion of balance sheet issues today, at our meeting this week. We'll have another at the next meeting and another at the meeting after that. I suspect these are interesting issues to discuss. Didn't make any decisions today. We looked back at what happened in the last cycle, and people thought that was interesting and informative. But to one degree or another, people noted that this is just a different situation, and those differences should inform the decisions we make about the balance sheet this time. So I haven't made any decisions at all about when runoff would start, but we'll
where all the 2018 analogy crash experts asks the market here.
Either liftoff happens or the
I like that one.
But those are exactly the decisions we'll be turning to in coming meetings.
Thank you. We'll go to Scott Horsley at NPR.
Thanks, Mr. Chairman. I think you said a few minutes ago that the inflation that we got during the pandemic was not the inflation that you anticipated when you crafted the framework, and you described it as a collision of a lot of monetary and fiscal stimulus with these supply side hiccups. Does that mean the stimulus was mistaken?
Well, once Fed coin
just a consequence of
is released, then you will be able to develop applications on it, and I want to develop applications on Fed coin.
In that comment,
Obviously, it has to come out first.
There's a sense among some that you wanted inflation. This is what you wanted. How do you like it? And the truth is, this is not the inflation what we were talking about in the framework was inflation that comes from a tight labor market, right? So we had 3.5% unemployment for a period, and we had
so far I'm happy with my take profit in the E-mini. I still think maybe they could keep going. We'll see.
Our thinking was
we're getting close to the end of him talking here, so I'm also kind of wondering if the treasuries do something interesting when he's done talking.
No one had seen what 3.5% unemployment would look like, with high labor force participation, by the way. No one had seen what it would really look like for an extended period for decades. And we didn't know what the inflationary implications were. Turned out there was barely 2% inflation and no sense that it was gaining momentum and that kind of thing. So we incorporated that into our framework. This is something completely different. That's a situation where you had a very, very high level of employment and low inflation. This is literally the opposite, or it has been the opposite, where we have very high inflation, and we've had it since the labor market was in terrible shape. It had nothing. So far, this inflation has really nothing to do with tightness in the labor market. It does have to do with strong demand, and strong demand was supported by the Fed. It was supported by Congress. I'm not making any judgments on Congress. It's not my job, but I will just say we're coming out of what we certainly hope will be a once in a lifetime, certainly historic, the first really global modern pandemic, which looked at the beginning like it might cause a global depression. And, so we threw a lot of support at it. And what's coming out now is really strong growth, really strong demand, high incomes and all that kind of thing. People will judge in 25 years whether we overdid it or not.
You bought some ES on that dip, or you bought some ZN on that dip?
We think our policy is the right one for the situation.
Laser eye. If you buy the ZN on that dip and you want to hold it for a few days, that's a gutsy trade, but it might work for you.
When you see the 10-year,
I have to say,
46 basis points, do you have any sort of concerns?
Oh, NQ. Okay, yeah, no NQ. I think you should be good.
Might be hiking interest rates into. Would you prefer?
I like it. I like your trade.
A little bit steeper. What are you gleaning from the bond market actions over the last 6 weeks?
So I think the short end actions are easy to understand, which is, they're basically very policy sensitive rates at the short end.
This is going to be important. Listen.
To changes in expectations for policy. I think a lot of things go into the long rates, and the place I would start is just look at global sovereign yields around the world. Look at JGBs, look at bunds, and they're so much lower. You can get a much higher yield on U.S. Treasuries by buying USTs rather than bunds, and you can hedge the currency risk back into yen, back into euros, and still be way ahead. So in a way, it's not surprising that there's a lot of demand for U.S. sovereigns in a world, in a risk-free world where they're yielding so much more than bunds or than JGBs. So that's a big part of it. I also think
4X Live tweets, Powell offering international bond trading tips and FX hedging now.
I don't know about that, but I would just say that we write down our own estimates of the terminal rate or the neutral rate of interest. Those are highly uncertain, and we'll make policy based on what we're seeing in the economy rather than based on what a model might say the neutral rate is. We all have the experience of the last cycle, where we all through that cycle were trying to estimate what the neutral rate was, and it turned out, I think we learned a lot from seeing what happens. We ended up cutting rates 3 times after raising them to 2.25% to 2.5%. So I'm not troubled by where the long bond is. I see that it's low. We're really focused on broader financial conditions. We're focused on maximum employment and price stability.
Are you listening, Zero Hedge? Did you hear that?
For the last question,
they're going to argue with him about that tonight. That's going to be their story. You go on. He's writing it right now. Why Powell is so wrong about the long interest rates and how they're predicting a policy error. But Powell says he's not concerned.
Policy stance had something to do with the timing of your re-nomination by the president. Thank you.
Sure, I'd be happy to talk about that.
Oh, and it looks like the ES did make a.
We got the ECI reading just before the
up there?
November meeting.
It's getting close.
The labor market report 2 days after the meeting. And
I'm kind of thinking about this and going like, maybe I want to sell it again.
CPI reading in concert with those two, and I just came to the view
over
that weekend that we needed to.
What do you think? Let's just put our stop up here and just let it ride.
10 days or so before.
I think this is the way to do it. I'm just gonna keep that sim short, and we're gonna let it ride.
That at all, and I just thought this is what we got to do. My colleagues were out talking about a faster taper, and that doesn't happen by accident. They were out talking about a faster taper before the president made his decision. So it's a decision that effectively was in more than in train, and to the point where people were talking about it publicly. So that's what happened, and it had absolutely nothing to do with it whatsoever. We're always going to just do what we think is the right thing, and I certainly will always just do what I think the right thing is for the economy and for the people that we serve.
Just a quick follow-up. I guess that some people saying that it was the the stimulus in March that was sort of over. We didn't really need all that stimulus, and that there was talk even then that would be a mistake and it would lead to higher inflation. and perhaps that you didn't push back as much as you might have.
The ES is a freight train. I have to say that first move, I was like, okay. But when they extended up to new highs, that's mighty impressive movement there in the ES, isn't it?
And we're not.
Let's see, where's my portfolio now?
We take fiscal policy as
Eh.
as it arrives at our front door, and we don't comment.
I mean, it's an update for me, but I really think I should make a lot more than that.
It's really not our role, and I think very important that we stay out of that business. No matter who's in the White House, who's in Congress, it's just not our job, and it's something we avoid pretty assiduously.
Thank you.
Thank you.
Thank you, Mr. Chair. Thank you, everyone.
All right, that's it. So now I can come back here. Oh, I never went away. I never went away. Nah, like he has a really good point, right? Like short-term interest rates, the 5-year moves largely off of expectations of future Fed actions. The 30-year, when you're going to hold something for 30 years, there's a lot more you have to think about. And where it is right now does not necessarily indicate some sort of a Fed policy error or anything like that. They have to think about generational trends in interest rates. They have to think about interest rates compared to other countries, the premium for holding duration, all of these other things that they model and go into the ZB. And for somebody to come in and say, well, because the 30-year is not selling very much, that means that the Federal Reserve is about to make a policy mistake is I think I don't get how people can come in and say things so confidently, because there's so many different factors involved, and but I'm gonna bet you, if I could put money on it, I would. I'm gonna bet you that that Zero Hedge is gonna have an issue with the statement that Powell just made there, and that there will be a story about it tonight. You watch on Zero Hedge about the long bond. Oh, now one thing that he did say is that the taper is not tightening. I'm sorry, but this is wrong. It's wrong. The reason why interest rates are as low as they are, I mean, like, even after the Federal Reserve meeting. Oh, hold on, the wife's here. Hold on. What? You got me food. Thank you so much. What is that? Oh, very nice. Okay. Anyways, us being below 1.5, I think, is still quite shocking to me. And why are we there? It's because these guys, they have to buy the bonds for the, and there's not very many of them out there because you keep buying them all, pal. Yeah. Tapering is going to increase rates? It is. It's going to increase rates, and that's less accommodative. So I would argue with them on that one. So can you imagine, like, the thing is like the ability to take multiple contracts and take on a lot of risk makes such a big difference. Because here, if I'm willing to lose like $10,000, and look, I can make $1,000 easy, even if I screw it up and don't get the lows. I should have been able to get 1,000 on the initial trade, but my DOM was kind of slow when it was going. Did you see where I was like, I kind of wanted to sell it or buy it down here, and by the time like the order even showed up, they were already back way up here. Like it snapped back real quick. And then we took some more trades down in here, so our average is at 16. Look at the treasury go there. I'm sure glad that I got out of that other one, the micros. It was like, they were like, Seth, we want to make sure that you make at least $10 today. And they gave it to me. The reaction was pretty insane. Well, so I just want to put a big disclaimer on this stream again. Two big disclaimers. Number 2, trading this kind of action is a little crazy. I'm a little crazy, okay? And this is a sim order up here in the 10-year treasury, all right? Number 2, it ain't over yet. Okay, we have a bunch of gamma expiring on Friday. We could still see some really bizarre stuff happen both tomorrow and Friday and next Monday, frankly. After that, I think that we have some positive flow. So remember this morning, I was like, there's another flow. I can't remember what it is. I remember what it is now. Okay, here's the other flow that you got to think about. End of year tax selling. So the end of year tax selling flows, according to data that we have in the past, like ends on the 15th, basically. So after, well, basically today and forward, we should expect at least, or at least our prediction is that there will be less selling in the indexes due to tax reasons. Okay. So that's a positive. And then again, we expect there to be some positive action in the equity indexes going into the end of the year. Maybe some of this damage where it's only like 5 stocks that are holding everything up. Maybe breadth increases a little bit here. I'm hoping. The strongest FOMC rally so far, I may well be. And the thing that I think is funny about this one is that it was hawkish. Like seriously, the decision that they made was, and frankly, even what he said was as hawkish as they could have reasonably have done. If they had been more hawkish than they were, it would have been crazy, and the market would have been blindsided by it. Right? It was as hawkish as it could have gotten. E-mini rose. So is there something in there that the E-mini really liked that said that's stimulative? Or no, I don't think it was. Like I really feel like this is just like a relief rally. Like, okay, the risk off move is done with. Now we can buy it. That's what it feels like to me. But we'll see. I'm gonna have to. We're gonna want to do a lot of reading tonight, a lot of research, seeing what different people think, and kind of try and judge what different flows were, to see if there was something in there that people thought was really ridiculously bullish or something, or what the deal was. I'll watch 4,700. Oh yeah, for sure. Well, that could be a magnet for sure. It's probably is going to be a magnet, and there's probably going to be a stop run through it as well. In fact, should we try taking a trade off of that? Let's see if we can get filled. We'll take a trade, and I'm expecting it to go through it for like at least 3 points. My wife brought me lunch. I am so hungry. I'm going to eat this, okay? I'm serious about this 10-year one over here. I'm just going to leave it short on forever. Like until the end of the year. I'm going to leave that on until the end of the year. See what happens. Should be fun. And we'll try and manage the position and stuff. Now, I keep reading melt up incoming in markets. Yeah, I think it's coming. Now, on the split side of that, let's just say that the market, that this FOMC was more dovish than the market anticipated or something like that. And that's why the S&P 500 is buying, and that's why Bitcoin is buying. Then I say, why are we still having such low yields in the treasuries? Why do they have a hard time getting back to 1.5? That does not make sense to me. No, you didn't. I used my text recognition algo to immediately jump in with 50 contracts on the NQ. There was not enough size on the NQ for you to do that at that time. Man, like, let's go and look at it, shall we? Chart NQ. Okay, so here's the event. I suppose if you put in a limit order, there might have been a spot that you got filled. Let's just come back and change this to a volume series. We'll say volume, and we'll say 50 volume in NQ. Okay, so how much happened in that initial move? Yep, I missed it. Where did it go? There we go. If you bought it long, then you took a lot of heat on against you at first. You had a lot of heat against you at first. So first of all, probably wasn't really the very effective trade, to be honest with you. But second of all, if you're going to come in and you're going to make a claim like that, you're going to have to post like a... You can't post links in here. You have to put like spaces around them, but you have to post a picture or something like that because I don't believe you. $50 contracts NQ. Give me a break. This guy, he's willing to trade 50 contracts and the most volatile instrument on the most volatile time or the most volatile day, and yet he has condescended to come down and visit us on our lowly stream today. Everybody give a hand to Sebastian Newman. We appreciate your presence. Oh, great one, who has traded 50 contracts on the NQ during FOMC. And if you really did do that, I kind of really have to question your intelligence, dude. Because number one, I don't think that there was anything in that FOMC statement that would really justify like buying into it with 50 contracts like that. And second of all, you took a lot of heat, man. Like it wasn't a very efficient entry. Oh, big early market on close imbalance, 1.5 billion sell side. Yeah, and I am down big time on that trade where I wanted to see them go up to the whatever, blah, blah, blah. I guess I got to give up on that one because that would be scratching it on my ES trades, right? 100, 180. Yep. But then I made 180 on this one. Yep. Break even on ES. Dang. Do you think it's ending here? Yeah, well, with the market on close like that. Whew, baby. I don't know. And by the way, like the treasuries came back up. Like the 10-year is just below where it started at the FOMC. Like there was this huge move down, but then they were never able to extend lower than that. It's just been buying ever since. Well, I wouldn't say it's just been buying ever since. The cumulative delta has been back and forth, but the buyers ultimately have been winning. Well, I know what you're... sorry, hold on a second. Oh, is GCC stand for Global Command Center? I thought we were talking about something else. Gary, is that you? Doesn't matter. I still don't believe you. Seriously, dude. Are you like 12? You really think what? I don't understand. You come in, you say, I took 50 contracts on NQ. You say it out of note, like that's the only thing you've said. And you just come in and brag about taking 50 contracts on the NQ. When, by the way, NQ took like a, wait, let's pull that chart back up. How far did NQ go down? Yeah, let's calculate this, shall we? NQ. We'll just do it by the minute, okay? 5 minute. So it'll be nice and compact chart for us here. In the NQs. Oh, so the NQ actually withstood that quite a bit better than ES did. It's okay. Okay, so if you were to have taken, let's say that you did 15,800, right? So here we have this nifty little drawing tool called risk reward somewhere, right? There you go, risk reward. So there's your risk, and then your reward was big. Okay, but, and then you can come in and if you go into the properties of it, I think you can tell it to Y display unit currency. So you risked $50,000. You were down on the trade at one point, $50,000, and then it went higher. And I'm sitting here like, okay, the person that can risk $50,000 doesn't come into my stream and tell me about it. I'm sorry. Doesn't happen. Doesn't happen. Think you're full of shit. I need some of that. Well, I mean, if you had like 100K account, then I guess you could do that, right? Jeez. Oh yeah, that's very bad. Working with a friend on an algorithm, and it wasn't matching. The back tests weren't matching up with his live, and so he kind of like restarted from scratch and did it again, and it got rid of the bug. But now the algorithm doesn't perform very well. Or even just doing one contract with NQ there is pretty whoosh. I need me some unlimited buy power. Now I can come over here and we can do this ruler thing, and we can go from here all the way up to there. That's pretty nice. Wait, can that one show me in? Yeah, Y display unit currency. There we go. $10,000 times 50. 500,000 bucks. That'd be an awesome trade if you took it, but I think you're full of shit. Maybe is one of those new Bitcoin new rich. Maybe. Or maybe I kind of liked the it's scary theory. In fact, I'm pretty sure like that name seems like familiar to me. I've been here before, and that maybe it was Gary told us that it was like their alt or something. Don't recall. That still wouldn't prove it to me. To prove it to me, I would need to see a broker statement, right? Even then, I'm not so sure that I would believe you. I would need to receive the broker statement like from the broker, from the CME. Mighty says, I miss you, man. Hey. Okay, how are you doing? By the way, what happened on the market on close? I wasn't paying attention. Let's come back over here to financial juice. In the end, it ended up being 1.1 billion sell side. I puked. That sucks. Oh, they're not going to touch 4,700 though? Well, they could. They could still do it into the close. They can still do it in the close. I kind of want to. Oh, come on. Okay, sure. Here, we'll size up a little bit so we can work it in. Work it. Yeah, it was 1.1 billion. Maybe they're willing to buy into him for it. I don't know. That's a pretty big imbalance sell side for sure, but I don't know. I've never seen a situation before where there was a really huge sell side imbalance into the close on such a bullish day. So I'm not quite sure how this is going to play out. He says, I'm not lying, but I wanted to see your reaction. I get people come in all the time and say total bullshit, man. This is just like no. They're reading on the market on close is good, especially once that 15. Once it crosses 315, you can't change because you're not allowed to submit orders or cancel them after that. Did they changed 1.5 buy to a sell? Well, you might have misread that.
The top of the
was it after 350?
As well as the US overall.
Because what you got to realize is that the market on close,
and as well as the US,
they're talking.
Hold on.
Market on close, you can put orders in that get executed on the market on close, and the cutoff for you to submit those orders is 10 minutes before the close. So when they read it out the first time, and you'll hear them usually read it out sometime around 3:30, right? Around 3:30, then that's just the initial one. That's just the initial one, and people can still submit orders, and that could completely flip around potentially, right? I forgot how many contracts I have on. I open this thing. Oh, okay, cool. But if it changes after 350, then that's shenanigans. Problem with 3:50 p.m. is when it's one directional, you can't really know what happens. Well, yeah, well, and again, like, you should also realize that somebody can put in a really big order. So I have seen a situation where it was on Financial Juice. They reported it, and then like right after they reported it, somebody put a huge order, and all of a sudden it was over $1 billion sell. In the markets, as soon as people saw that order come in, like, the market started tanking. It was pretty crazy. And everybody in chat were like, "What's going on? I don't understand what's going on." It's because they're selling. They're selling on the close, so we should sell to it. We need to sell now so that we can buy it back from them on the end. It worked. It was a good trade. Okay. Oh, we pushed through. All right. Good deal. All right. Yeah, it is odd that you found the stream. Although I'm still feel like I've seen your name before. And I still think you're Gary, but whatever. I won't ban you unless you start saying dumb stuff, right? The one that irritates me is when people come in and they start putting like objectively false things in the chat. That makes me mad. Okay, here it comes. Woo! Look at that. That's quite a bit. Quite a bit of volume there on the close. We should be able to just chill here for a little bit, like let it sit for 5 minutes and see what they do. You back from? Yeah, I'm off work right now. I have no work until after Christmas, essentially. And then even after Christmas, the work that I have will be pretty lax. I'll be on support when almost nothing happens, so I'll probably be able to still, do study and stuff. Be more work-related study, but what'd you go for? Yeah. We are related to John Paulson. That's funny too. Is just like, it's not that. It's like I've had some people. The thing is, I've had some people come into the stream that were heavy hitters. And they showed me stuff. I won't say what, but that kind of person doesn't like to call themselves out, you know? They don't want everybody in the stream to know that that's what they're doing. So that's the main reason why I'm be like, nah. First time somebody says something, they're bragging about the trick, you know. Nah. Don't believe you. Yeah, I feel like I've been getting too much off of my break so far, though, NASDAQ Trader. All I've done is gotten TensorFlow running and understanding what a few of the commands are, but I don't know how to make a TensorFlow model yet. So we're working on that. Nobody, I mean, I don't know any names. I've just had people show me individual trades that were really big. Like somebody showed me once in Bitcoin after the Bitcoin crash that my call that Bitcoin was going to crash in 2017 saved them like $60,000. I was like, whoa. It was a little disconcerting that somebody got out of Bitcoin just because of me. But hey, I was right, so. And then if we had bought back in, we never really got my buy back in there. Like if it goes to your buy back in and we make money from it, I'll give you the $60,000, but we never got to that spot. Python, yeah, it's Python. I'm trying to do TensorFlow with Python. Yeah. So I'll show it to you. You want to see? I mean, I kind of pulled this off of the NinjaTrader 8 forum, so it needs some work. I'm not sure if putting it into a strategy is the right way to do it or not. So you got to create a socket, all this stuff, and then here's the thing that will get instructions. So it will send all this information through the socket, and then it will wait for the TensorFlow model to tell it what to do, essentially. And over here is just adding random data to the thing that it's going to send. So here's what it sends. And then on the other side of it, I'll go find it here. Actually, I should be able to just open up Notepad++. Is probably still open. It was just somebody had written it on the forum. Okay, and then here is, oh no, that's the Hello World one. Then here's the side on the TensorFlow model. It gets the stuff and it adds it into the thing. I think it's incomplete though, because it's not, I don't have anything that's sending anything back, I don't think. Let's see here. Connection receive. Oh no, it does. It does post a response. I don't know. It doesn't seem to do anything though when I load it up. I don't understand very much about how this stuff works. And if I said I would place a large order in the market, you could actually identify. Sure. Yeah, if you went in on the NQ here, I have it open. And if you put, well, you'd have to put it pretty close. Wait, can I see more than that on NQ? I think I might be able to see more than that on NQ. Let's try adding a couple more. Wouldn't want you to put it somewhere where like you'd really have a hard time getting filled, right? I guess I can only see 10. You'd have to put it at 10, but if you put like a 50 lot at 294 there, then I would be like, oh yeah, that would have to be, it probably would be a bad idea, huh? It's too close and too slippery to do something like that. Did you run it? Yeah, it runs. It just doesn't do anything though. So we'll see. This afternoon though, I got to get back into my book, I think. What was I doing? I was doing something else this morning. Maybe it was. Oh, there was some TensorFlow documentation that I read. So, but the documentation that I read, I think, kind of assumed some machine learning expertise, because it was basically what it was saying is like, you can make a matrix, and then you connect all of the matrices together and tell it what the model looks like, and it runs it. And I was like, I don't understand that at all. So I think I need a better entry point than their documentation. Probably need to go find a video or something. You're 17. That's very impressive. I have, man, when was it? I can't remember, but one time somebody showed us, flashed some size for us. I think it's funny. It was like, sometimes when we're doing that sort of a thing, like I could see everybody else do it. I'm like, there's only like 30 people watching, but all you guys clicked. That happened one time. You remember that? I think you were around for that, NASDAQ trader. Do you remember that? Like, I was like when the micros first showed, and I was like, see here, look, I can put my size on it, and then all of a sudden around that area a bunch of ones and stuff showed up. No, but somebody did one time flash like I don't remember how big it was, but a relatively large order in the ES for us that you could very clearly see it was adding on and off. And I was mighty impressed. Well, there you go. 46.95 if you did 46.95 in ES. See what it does, that would be. Then maybe I would kind of... I'm not sure I would still believe that you actually took the trade and made $50,000, but hey, if you made $50,000, you want to share some of it? Because I'm not that good. Next thing I want to learn is those obscene spreads. I've been doing reading and stuff about spread trading in the treasuries, you know? And, I mean, you get all this stuff about the mechanics of it and everything, but I think that there's got to be some like technical behaviors about it too, and I haven't found anything on that. I think that the smart people keep that one to themselves. Now I'm sitting here thinking, well, if he's only 17, yeah, maybe that is kind of the sort of thing that a 17-year-old would do. And now I'm thinking, like, dude, you could be responsible. Like, that's kind of a crazy trade to take. Okay, so let's, I mean, we are after market here. Let's just check here a little quick, see what their market synopsis here on Zero Hedge was. I meant Python. Yeah, well, the Python itself isn't too hard to learn. Okay, we have something to get off our chest, and it appears that no reporters had the balls to ask Jay Powell during the presser. Based on the taper / dot plot / SCPs, how exactly will tighter financial conditions lead to faster GDP growth, higher inflation, and lower unemployment? I don't understand why you're saying there. Tighter financial conditions should lead to lower inflation. Okay, well, whatever. Money markets now see a 90% chance of an April rate hike. Yes, that makes sense. Additionally, the market is pricing in a regime shift back to rate cuts late 2024, early 25. At least a little. I mean, they're kind of putting a little bit of a thing there, but I don't think that necessarily actually means that people think it's going to be rate cuts. It just means to me that more people think that there will be a rate increase right there than there. Okay. Powell did the usual whackback of the statement's hawkishness in the press conference, throwing out every caveat imaginable. I didn't really read it like that, but okay. As the dollar was the arbiter of truth and shifted rapidly from stronger to weaker as he spoke. Yes, it did. And so, but it was kind of weird how all the other assets split, right? A shift along with the inversion of the forward curve, the signal the Fed will make a policy mistake. Yeah, of course they're going to say that shit. It's not true, but okay, whatever. And we wonder, I mean, it could be, but that just on its own doesn't, they say this is a proxy of policy mistake. No, it's not. It's way more complicated than that. And we wonder out loud if that is what prompted the gains in the stock market against this uber hawkish statement. NASDAQ literally exploded higher, ending up a stunning 2.3%. Well, okay, so they themselves aren't 100% sure why the NASDAQ exploded higher. They also thought that was kind of weird. Dow burst back above its 50-day EMA, and NASDAQ, which opened below its 100-day moving average, burst above that and extended above its 50. Blah, blah. Cyclicals outperformed. Defensive outperformed easily on the day. Market rate expectations are below every dot in 2024. Traders basically getting ready for the next easing cycle. Yeah, so graphically it looks like this. The Fed is now more hawkish across the entire curve than the market. Yes, that is the case. But here's the question. Why? Is the market really seeing a slowdown the start of 2022? Is it because of short-term liquidity concerns still? Is it because of, as Powell mentioned, the 30-year, that our rates are higher than Europe? Is it because of Omicron? I don't know. Because if it's any of those things, then interest rates will come up, and when they do, they will be much more aggressive about it. But we'll see. The yield curve dramatically flattening, then retracing. Yes. Crypto stormed higher. That is not what happened. Okay. Well, the cryptos made their initial move, but apparently when Powell said crypto isn't a threat to financial stability, they liked that. Well, okay, we'll see that. We'll see. I disagree with them on that too. Commodities lifted on the Fed and accelerated as the dollar dived with WTI ramped up above 71.50. Yay! Okay. Gold puked as it does on Fed Day, but the dollar's drop on policy error fears sent gold spiking higher. Okay. Don't bother, Sebastian. I don't really care. You don't have to prove anything. I would just say, like, don't make claims, because I don't care. I won't believe you anyways. There's no reason. You know what will impress me? What will impress me is you come in and you give us a piece of information that's tradable and helps us. That's the sort of thing that impresses me. So when somebody comes in and they say, well, we're seeing that thing happen, and here are a couple of different theories about why that might be happening. Or you mentioned this thing, but here's one potential flow that you might have missed. And they go, oh yeah, that totally would potentially cause buying in the S&P 500 and move us up. I'm really glad that you mentioned that. That's the sort of thing that impresses me. Okay. Don't forget big options expiration on Friday with lots of gamma to unclench. The other interesting scenario here is that the market catches a bid from Powell's appearance. Typically, the Fed tries to placate markets and implied volatility subsides. In this case, vanish/charm flows may kick in pre-OPEX, leading to a sharp rally into Friday after 4 straight down days for Goldman's most shorted stocks. This scenario could be the trickier one, as the short cover relief rally could lose steam post-OPEX. OPEX. So, there you go. Okay, Financial Juice is talking. I'm just gonna close them. So guys, I got nothing left for you. Good day, I guess. I mean, I didn't really trade it, so I shouldn't. I did make $12 today, but it's so funny. It is like, I made $12. Yeah, I made 50,000. Well, I believe you, but okay. There you go. It was inappropriate. If I say anything, it will be informative rather than outright right. Hey, good. Thank you. Like you know, I just want to reiterate here, we've been talking about a lot, but because I made some bad trades last week. Oh, I made some bad trades last week. I feel so dumb about it. I mean, we'll live on. It's not a big deal, but I don't want to do bads. I want to do well so badly. I want to do bad. I want to do well so badly, but I kind of realized that it was like, you know, what matters more is I'm helping you guys, and that you guys are enjoying yourself is the most important thing. Because I don't necessarily expect to make much money from the trading. I don't have a huge wad to trade, right? And I think that I have a lot of really good information that the traders should know, yeah, about how order flow affects, how the market microstructure, affects the market's behavior. So don't be down your purposes to help us make it. Yeah, maybe I can't do it, but maybe Sebastian here, because he is not allowed, but he is able to, trade $50,000 trades in one afternoon. He could do it, and the information that I have, that it could help him make money, because he would have the ability to really truly take the risk on to really make the big plays, right? So somebody will. It still has value, even if I don't necessarily expect. Of course, I'm going to try as hard as I can to make money and improve. Most important, says I want to get better at it, but I don't necessarily expect to make tons of money. Let's just not lose money like that again, though, huh? You ever started the combine? Oh, I've done the combine many, many times. It's kind of funny. Like, I had a hard time doing the combines, and then when I stopped doing them, those was when I started to have some performance runs that would have passed. New non-judgmental Seth, yeah. I need to get the bots. So I ran that one bot. Oh man, that one was so frustrating. I think there was some big flaws in that bot, but it totally would have passed that 1 month. And then it just happened that was the month when the volatility spiked, and so it didn't pass. That's what I was trying to get across in that one video that I made about it. Now it had another one, J4 or whatever. Also had a period that would have passed, but I think I can make him better. I think that with the machine learning, I'm hoping that machine learning is like this magic arcane formula that will magically make it as consistent as I want. Well, the combine works if you actually make money, but it's just the amount of money that they're expecting you to make is quite crazy. Right, you're really unlikely to hit their metrics. I think most people are LARPing about their size. People with real size don't advertise. I don't know. If you're 17, he said he was 17, right? That's, 17-year-old might not realize that he shouldn't be telling us that he swings 50K, right? I'm sure that there are people here on the stream that really trade big size and have been friends of the stream and just don't say anything. There aren't people who speak truthfully about the markets. Not many watch the stream because you actually talk about real information that professionals base their business on. There you go. Exactly. Well, it's like I try and talk about future predicted flows that could be coming into the markets. Retail traders don't want to think that hard. They just want, okay, when you see this pattern in the candlesticks, if it's a doji followed by an outside bar, then you want to buy. And here's where you put your stop and your target easy, They don't want to think. I'm just saying, if he had that much size and he was 17, maybe that would explain why he would say that. Well, because when somebody talks about that much size, I'm immediately thinking, oh, this is like 40, 50-year-old guy that's been doing it forever. And those people, they really don't like to talk about how big their account is. Right. Hey guys, we've gotten like way over. I'm gonna read about statistics. So I will see you guys tomorrow. In the meantime, stay profitable, friends.